Question 1. Risk assessment procedures indicate that a prospective associated person seeking registration in California has a past disciplinary action from a prior employer that occurred 5 years ago, involving a minor infraction that resulted in a warning. What is the most appropriate course of action for the firm to ensure compliance with California's registration requirements? Option A. Provide a brief summary of the disciplinary action on the Form U-4, emphasizing its minor nature and downplaying the details of the infraction. Option B. Wait for the California Regulatory Authority to specifically inquire about any past disciplinary actions before disclosing the information. Option C. Assume that because the disciplinary action was minor and occurred 5 years ago, it does not need to be disclosed on the Form U-4. Option D. Ensure the prospective associated person's Form U-4 accurately and completely discloses the prior disciplinary action, including the nature of the infraction and the outcome. Correct answer is D. Ensure the prospective associated person's Form U-4 accurately and completely discloses the prior disciplinary action, including the nature of the infraction and the outcome. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a firm to navigate the complexities of registering an associated person who has a past disciplinary action. The firm must balance its obligation to comply with regulatory requirements with its desire to onboard a potentially valuable employee. Misinterpreting or misapplying registration rules can lead to significant regulatory penalties, reputational damage, and potential harm to investors. Careful judgment is required to ensure all disclosure obligations are met accurately and promptly. Correct approach analysis. The best professional practice involves proactively and thoroughly disclosing the prior disciplinary action to the relevant regulatory bodies in the state of California. This approach acknowledges the firm's responsibility to provide complete and accurate information during the registration process. Specifically, the firm must ensure that the associated person's Form U-4 accurately reflects the disciplinary history, including the nature of the offense, the date, and the outcome. This transparency is a cornerstone of investor protection and regulatory oversight in California. The firm should also conduct an internal review to assess the nature of the past offense and its potential impact on the individual's suitability for registration. But the primary regulatory obligation is full disclosure. Incorrect approaches analysis. One incorrect approach is to assume that because the disciplinary action occurred several years ago and was minor, it does not need to be disclosed. This is a direct violation of California's registration requirements, which mandate disclosure of all reportable events, regardless of their perceived severity or age. Failing to disclose such information is considered a misrepresentation and can lead to severe penalties for both the individual and the firm, including denial of registration, fines, and disciplinary actions. Another incorrect approach is to delay the disclosure until specifically asked by the regulator. Regulatory bodies expect proactive disclosure of all material information during the registration process. Waiting to be asked implies an attempt to conceal information, which is viewed unfavorably and can result in more stringent scrutiny and penalties. The firm has an affirmative duty to ensure the accuracy and completeness of the Form U-4. A further incorrect approach is to attempt to downplay or minimize the significance of the disciplinary action on the Form U-4 without providing full factual details. While the firm may believe the action was minor, the regulatory body is responsible for making that determination based on complete information. Omitting key facts or providing misleading descriptions constitutes a failure to provide accurate information, which is a serious regulatory offense. Professional reasoning. Professionals should adopt a when in doubt, disclose mentality when it comes to registration requirements. The primary goal of these regulations is to protect the investing public. Therefore, any past event that could potentially reflect on an individual's honesty, integrity, or ability to comply with securities laws should be disclosed. Firms should have robust internal compliance procedures that include a thorough review of an applicant's background and a clear understanding of what constitutes a reportable event under California securities law. When faced with a situation involving a past disciplinary action, the firm should consult the specific disclosure guidelines for Form U-4, and if necessary, seek guidance from legal counsel or compliance experts to ensure full and accurate compliance. Question 2. Risk assessment procedures indicate that a principal in California is considering how to present information about a newly issued municipal bond to potential investors. The principal is aware of the bond's potential for high yield, but also recognizes some underlying risks related to the issuer's financial stability. Which of the following approaches best aligns with the prohibitions against manipulative and deceptive devices under U.S. Federal Securities laws and FINRA rules? Option A. Conduct a comprehensive analysis of the municipal bond's financial underpinnings, including the issuer's creditworthiness, debt service coverage, and the economic outlook for the issuing municipality, and present all findings, both positive and negative, in a balanced manner. Option B. Create a sense of urgency by suggesting that the bond is in high demand and may soon be unavailable, encouraging immediate investment without detailed discussion of its fundamentals. Option C. Emphasize the bond's attractive yield and potential for capital appreciation, while briefly mentioning the risks without elaborating on their potential impact. Option D. Focus solely on the positive aspects of the bond's issuance and market demand, suggesting that its price is likely to increase significantly due to anticipated investor interest. The correct answer is A. Conduct a comprehensive analysis of the municipal bond's financial underpinnings, including the issuer's creditworthiness, debt service coverage, and the economic outlook for the issuing municipality, and present all findings, both positive and negative, in a balanced manner. Explanation. This scenario is professionally challenging because it requires a principal to distinguish between legitimate market analysis and potentially manipulative practices, particularly when dealing with new or complex municipal securities. The pressure to generate returns or attract business can create a temptation to engage in behavior that, while not explicitly illegal on its face, could be construed as deceptive or manipulative under FINRA rules, which govern the conduct of municipal securities principals in the United States. A careful judgment is required to ensure all communications are fair, balanced, and do not mislead investors. The best approach involves a thorough and objective assessment of the municipal securities fundamentals, including its financial health, market demand, and any relevant economic factors impacting its value. This approach prioritizes providing investors with accurate and unbiased information, thereby adhering to the prohibition against manipulative and deceptive devices as outlined in FINRA Rule 2010 and SEC Rule 10b-5. By focusing on factual analysis and avoiding speculative or exaggerated claims, a principal ensures that any recommendations or discussions are grounded in reality and serve the investor's best interest, rather than attempting to artificially influence the security's price or perception. An approach that involves selectively highlighting only positive information while downplaying or omitting negative aspects is a failure to provide a fair and balanced picture. This can mislead investors into making decisions based on incomplete or biased data, which constitutes a deceptive practice. Similarly, an approach that relies on unsubstantiated predictions of future price movements or market sentiment without a sound analytical basis can be considered manipulative. Such tactics aim to create a false impression of certainty or inevitability, which is contrary to the principles of fair dealing and investor protection. Furthermore, an approach that involves creating a sense of urgency or scarcity around the security without genuine market justification can also be viewed as deceptive, pressuring investors into making hasty decisions. Professionals should employ a decision-making framework that begins with understanding the spirit and letter of regulations prohibiting manipulative and deceptive devices. This involves critically evaluating all communications and actions for potential to mislead or unduly influence market perception. A key step is to ask, is this information complete, accurate, and presented in a way that allows an investor to make an informed decision, or could it be interpreted as an attempt to manipulate their perception or the market? If there is any doubt, erring on the side of caution and providing more comprehensive, objective information is the prudent course of action. Question 3. The monitoring system demonstrates a significant increase in the volume of municipal fund security transactions executed by a registered representative in California, with a notable concentration in high-risk municipal bond funds. Which of the following approaches best ensures compliance with regulations established to protect investors in municipal fund securities? Option A. Conduct a detailed review of the representative's trade blotter, focusing on the suitability of these transactions for the specific client profiles, and cross-reference findings with customer complaints and inquiries related to municipal fund securities. Option B. Prioritize an analysis of the representative's revenue generation from municipal fund security sales to assess overall business performance. Option C. Rely on the registered representative's assurance that all transactions were suitable and that clients were fully informed of the risks involved. Option D. Initiate a full-scale audit of the representative's municipal fund security sales only after a formal customer complaint is lodged concerning these transactions. The correct answer is A. Conduct a detailed review of the representative's trade blotter, focusing on the suitability of these transactions for the specific client profiles, and cross-reference findings with customer complaints and inquiries related to municipal fund securities. Explanation: this scenario is professionally challenging because it requires a principal to balance the need for efficient operational oversight with the absolute imperative of investor protection under the Municipal Securities Rulemaking Board (MSRB) rules, specifically those pertaining to disclosure and suitability in the state of California. The principal must identify potential risks to investors stemming from a registered representative's sales practices without unduly hindering legitimate business operations. The best approach involves proactively identifying and addressing potential red flags that could indicate a pattern of unsuitable recommendations or inadequate disclosure to municipal fund security investors. This includes reviewing trade blotters for unusual activity, such as frequent churning of municipal fund securities, disproportionate allocation of client assets to specific fund types without clear client benefit, or a high volume of sales to clients with conservative investment profiles. Furthermore, it necessitates a review of customer complaints and inquiries related to municipal fund securities to identify any recurring themes or specific concerns. This proactive, data-driven risk assessment aligns with MSRB Rule G17, Conduct of Municipal Securities Business, and MSRB Rule G19, Suitability of Transactions, which mandate that dealers ensure that recommendations are suitable for their customers and that customers are provided with fair and balanced information. By focusing on these indicators, the principal directly addresses potential violations of investor protection regulations. An incorrect approach would be to solely rely on the registered representative's self-reporting of their sales activities. This method is insufficient because it lacks independent verification and does not account for potential blind spots or intentional omissions by the representative. It fails to meet the principal's obligation under MSRB rules to conduct diligent supervision and oversight, potentially leading to undisclosed risks for investors. Another incorrect approach is to only investigate when a formal customer complaint is received. This reactive strategy is inadequate as it allows potential harm to occur before any action is taken. MSRB rules emphasize a proactive approach to supervision and investor protection, meaning that supervisors should identify and mitigate risks before they result in formal complaints or significant investor losses. Finally, an incorrect approach would be to focus exclusively on the profitability of the registered representative's municipal fund security sales. While profitability is a business consideration, it cannot supersede the regulatory requirement to ensure that sales are suitable and that investors are protected. An overemphasis on sales volume or revenue, without considering the appropriateness of the investments for the clients, represents a significant failure in fulfilling supervisory duties and protecting investors. Professionals should employ a decision-making framework that prioritizes investor protection by integrating regulatory requirements with a robust risk assessment process. This involves establishing clear supervisory procedures, utilizing technology to monitor for red flags, conducting regular and thorough reviews of registered representatives' activities, and fostering a culture where ethical conduct and client best interests are paramount. When potential risks are identified, a systematic approach to investigation and remediation, consistent with MSRB rules, must be implemented. Question 4. A principal at a California-based municipal securities firm is reviewing a new offering of a municipal fund security. The issuer is a California municipal authority, and the offering documents state that the security is exempt from registration under the Investment Company Act of 1940 pursuant to Section 2B. What is the principal's primary responsibility in evaluating this claim of exemption? Option A. Assume the exemption is valid based on the issuer's representation and the fact that it is a municipal security. Option B. Determine that since the security is issued by a California municipal authority, it is automatically exempt from federal registration requirements. Option C. Independently verify that the specific characteristics and structure of the municipal fund security meet all the statutory requirements for exemption under Section 2(b) of the Investment Company Act of 1940. Option D. Rely exclusively on the legal opinion provided by the issuer's counsel regarding the federal exemption. Correct answer is C. Independently verify that the specific characteristics and structure of the municipal fund security meet all the statutory requirements for exemption under Section 2(b) of the Investment Company Act of 1940. Explanation. This scenario presents a professional challenge because a principal of a municipal securities firm in California must determine the applicability of the Investment Company Act of 1940 to a specific municipal fund security offering. Misinterpreting the exemptions available under Section 2(b) of the Act can lead to significant regulatory violations, reputational damage, and potential penalties. The principal's judgment is critical in ensuring compliance and protecting both the firm and investors. The best approach involves a thorough review of the specific characteristics of the municipal fund security and its offering documents against the criteria outlined in Section 2(b) of the Investment Company Act of 1940. This includes verifying that the security is issued or guaranteed by a state or political subdivision, or that it falls under other specific exemptions provided by the Act, such as those for certain types of insurance companies or banks. A principal must actively seek and confirm that the offering meets all statutory requirements for exemption, rather than assuming exemption based on the issuer's municipal status alone. This proactive and detailed verification ensures adherence to federal securities laws, which are paramount even for municipal securities. An incorrect approach would be to assume that any security issued by a municipality is automatically exempt from the Investment Company Act of 1940 without further investigation. While many municipal securities are exempt, Section 2(b) has specific conditions. Failing to confirm these conditions could lead to the offering being subject to the Act's registration and regulatory requirements, resulting in a violation. Another incorrect approach is to rely solely on the issuer's representation that the security is exempt. While the issuer's statement is important, the ultimate responsibility for determining compliance with federal securities laws rests with the underwriter and its principals. The principal must independently verify the basis for any claimed exemption. Finally, an incorrect approach would be to consult only state-level regulations for guidance on federal exemptions. While California securities laws, the Corporate Securities Law of 1968, apply to municipal securities offerings within the state, they do not supersede or replace the requirements of the Federal Investment Company Act of 1940. Federal law governs the applicability of federal exemptions. Professionals should employ a decision-making framework that prioritizes regulatory due diligence. This involves 1. Identifying the relevant regulatory framework, in this case, the Investment Company Act of 1940 and its exemptions. 2. Analyzing the specific facts and circumstances of the security offering. 3. Comparing these facts against the precise criteria of any claimed exemption. 4. Documenting the basis for the exemption determination. 5. Seeking legal counsel if there is any ambiguity. Question 5. Analysis of a situation in Ontario, Canada, where a senior sales representative for a firm registered with the Investment Industry Regulatory Organization of Canada, IIROC, has been consistently recommending municipal securities to a specific segment of clients, generating significant commissions. However, concerns have been raised internally that these recommendations may be based on an aggressive sales strategy rather than a thorough assessment of individual client suitability and risk tolerance, potentially contravening IIROC Dealer Member Rule 20. The principal overseeing this representative must decide on the most appropriate course of action. Which of the following approaches best addresses this situation? Option A. Immediately initiate a comprehensive review of the sales representative's client files and trading activity, focusing on suitability assessments and client communications related to municipal securities, and take appropriate supervisory and corrective actions based on the findings. Option B. Confront the sales representative directly and ask for their justification for the sales strategy before conducting any independent review of their client interactions or relevant IIROC rules. Option C. Issue a general reminder to all sales staff about the importance of suitability and fair dealing in municipal securities sales without investigating the specific concerns raised about the senior representative. Option D. Continue to monitor the situation passively, assuming the representative's success indicates compliance, and only intervene if a formal complaint is received from a client or IROC. The correct answer is A. Immediately initiate a comprehensive review of the sales representative's client files and trading activity, focusing on suitability assessments and client communications related to municipal securities, and take appropriate supervisory and corrective actions based on the findings. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's business interests with the paramount duty to ensure compliance with Municipal Securities Rulemaking Board, MSRB, Rule G17, which mandates fair dealing with customers. The principal must make a judgment call on how to respond to a situation where a sales representative might be engaging in practices that, while potentially profitable, could violate MSRB rules and expose the firm to regulatory scrutiny and reputational damage. The core of the challenge lies in identifying and rectifying potential misconduct without unduly hindering legitimate sales activities. The correct approach involves a proactive and thorough investigation that prioritizes regulatory compliance. This entails immediately reviewing the sales representative's practices, specifically examining whether the recommendations align with customer suitability standards, and if any undue pressure or misrepresentation is occurring, as prohibited by MSRB Rule G17. The principal should gather all relevant documentation, including trade blotters, customer account statements, and any communications between the representative and clients. If the review reveals potential violations, the principal must take prompt corrective action, which may include retraining the representative, implementing stricter supervision, or, in severe cases, disciplinary measures, while also considering the need to inform affected customers if their accounts have been compromised. This approach directly upholds the MSRB emphasis on fair dealing and the principal's supervisory responsibilities. An incorrect approach would be to dismiss the concerns without a proper review, assuming the sales representative is acting appropriately simply because they are generating revenue. This fails to acknowledge the principal's supervisory obligation under MSRB rules to oversee sales practices and ensure fair dealing. Another incorrect approach is to address the issue by merely issuing a general reminder about MSRB rules without investigating the specific allegations or reviewing the representative's conduct. This is insufficient as it does not address the root cause of the potential problem and may not prevent future violations. Finally, an approach that involves confronting the sales representative and demanding an explanation without first conducting an objective review of the facts and relevant regulations is premature and could lead to an incomplete or biased assessment of the situation. Professionals should employ a decision-making framework that begins with identifying potential compliance issues. This should be followed by a fact-finding stage, involving the collection and analysis of relevant data and documentation. Next, the professional must consult applicable regulations, in this case, MSRB rules, to determine if any violations have occurred. Based on the findings, a determination of appropriate corrective action should be made, prioritizing client protection and regulatory adherence. This systematic process ensures that decisions are informed, defensible, and aligned with professional and regulatory standards. Question 6. The review process indicates that a municipal securities dealer registered in California has received a formal request for information from the California Department of Financial Protection and Innovation, DFPI, regarding a potential violation of Section 15B, C, 5 of the Securities Exchange Act of 1934. The DFPI is investigating whether the dealer failed to supervise a registered representative who engaged in prohibited practices. What is the most appropriate course of action for the municipal securities dealer? Option A. Provide only the information that directly implicates the firm, while withholding any documentation that might suggest broader supervisory failures. Option B. Delay providing the requested information, citing ongoing internal reviews, in the hope that the investigation will lose momentum. Option C. Fully cooperate with the California DFPI by providing all requested information and documentation promptly and accurately, and engage in open communication regarding the investigation. Option D. Ignore the inquiry from the California DFPI, assuming that as a federal act, only the SEC has jurisdiction. The correct answer is C. Fully cooperate with the California DFPI by providing all requested information and documentation promptly and accurately, and engage in open communication regarding the investigation. Explanation. The review process indicates a potential violation of Section 15B, C. 5 of the Securities Exchange Act of 1934, which grants the Securities and Exchange Commission, SEC, the authority to censure, suspend, or revoke the registration of a municipal securities dealer or its associated persons for violations of the Act or rules promulgated thereunder. This scenario is professionally challenging because it requires a municipal securities dealer to navigate the complexities of regulatory enforcement while upholding its duty of fair dealing and compliance. The dealer must make a judgment call on how to respond to an inquiry from a state securities regulator, which may be acting in concert with or independently of the SEC, concerning potential violations of the 34 Act. The best professional approach involves a proactive and transparent engagement with the state securities regulator. This means promptly and accurately responding to the regulator's information requests, cooperating fully with their investigation, and providing all requested documentation and explanations. This approach aligns with the spirit of Section 15B, C. 5, by demonstrating a commitment to compliance and a willingness to address any potential issues directly. Furthermore, it reflects the ethical obligation of a registered municipal securities dealer to cooperate with regulatory authorities, as implied by the regulatory framework governing their operations. This proactive stance can mitigate potential penalties and demonstrate good faith to the regulator. An incorrect approach would be to delay or obstruct the regulator's investigation. This could involve providing incomplete information, making excuses for noncompliance, or attempting to hide relevant documents. Such actions would likely be viewed as a lack of cooperation and could exacerbate the situation, leading to more severe enforcement actions under Section 15B, C. 5, and potentially other provisions of the 34 Act. Another incorrect approach would be to ignore the inquiry altogether. This is a direct contravention of the dealer's obligation to respond to lawful requests from regulatory bodies, and would almost certainly result in significant penalties, including potential suspension or revocation of registration. Finally, attempting to mislead the regulator with inaccurate or fabricated information is a serious ethical and regulatory breach, which would not only lead to severe enforcement actions, but also damage the firm's reputation and trustworthiness. Professionals should adopt a decision-making framework that prioritizes immediate and thorough compliance with regulatory inquiries. This framework should involve 1. Acknowledging the inquiry promptly and confirming receipt. 2. Assembling a compliance team, including legal counsel if necessary, to understand the scope of the request. 3. Gathering all requested information accurately and completely. 4. Responding to the regulator in a timely and transparent manner, offering explanations where appropriate. 5. Documenting all communications and actions taken during the investigation. Question 7. Performance analysis shows that a client's investment account at your firm in Ontario, Canada, has grown significantly and now exceeds the maximum coverage limit provided by the Securities Investor Protection Corporation, SIPC. The client, concerned about the safety of their funds, asks for a clear explanation of how SIPC protection applies to their account. Which of the following approaches best addresses the client's inquiry while adhering to regulatory requirements? Option A. Dismiss the client's concerns by stating that the firm's strong financial standing makes SIPC coverage less relevant for their account. Option B. Assure the client that their entire account balance is fully protected by SIPC, as the firm is a member in good standing. Option C. State that SIPC covers all accounts held by member firms, without mentioning any specific limits or conditions. Option D. Explain that SIPC protection has a per-customer limit, and provide the client with official SIPC literature, and direct them to the SIPC website for detailed information on coverage limits and what is covered. Correct answer is D. Explain that SIPC protection has a per-customer limit, and provide the client with official SIPC literature, and direct them to the SIPC website for detailed information on coverage limits and what is covered. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to navigate the complexities of customer account protection under the Securities Investor Protection Corporation, SIPC, framework, specifically concerning the limits of coverage and the nature of eligible claims. A principal must exercise careful judgment to ensure that customer expectations are managed accurately, and that the firm adheres strictly to SEPA provisions, particularly when dealing with a customer whose account value approaches or exceeds SIP limits. Misunderstanding or misrepresenting SIP coverage can lead to significant regulatory violations, customer dissatisfaction, and potential legal liabilities for the firm. Correct approach analysis. The best professional practice involves clearly and accurately communicating the limitations of SIP coverage to the customer. This means explaining that SIP protection has a per-customer limit, and that certain types of assets or claims may not be covered. Providing the customer with official SIP literature and directing them to SIP website for definitive information ensures transparency and compliance with regulatory expectations. This approach prioritizes accurate information dissemination and customer education, aligning with the firm's duty to act in the customer's best interest and to comply with the Securities Investor Protection Act of 1970 (SEPA). Incorrect approaches analysis. One incorrect approach is to assure the customer that their entire account balance is fully protected by SIP, regardless of its value. This is a direct misrepresentation of SIP coverage limits, which are established by SEPA Section 5 and Section 9. Such an assurance could lead the customer to believe they have protection beyond what is legally provided, creating a false sense of security and potentially exposing the firm to claims of negligence or misrepresentation. Another incorrect approach is to dismiss the customer's concerns about SIP coverage as irrelevant, suggesting that the firm's financial stability is sufficient. While firm stability is important, it does not negate the statutory protections offered by SIP, nor does it absolve the firm of its obligation to accurately inform customers about SIP role and limitations. Finally, an incorrect approach would be to simply state that SIP covers all accounts without any qualification or explanation of limits. This is an oversimplification that fails to provide the customer with the necessary details to understand the scope of their protection. Professional reasoning. Professionals should approach customer inquiries about SIP coverage with a commitment to accuracy and transparency. The decision-making process should involve 1. Understanding the specific provisions of SEPA Sections 5 and 9 regarding coverage limits and eligible claims. 2. Recognizing the firm's obligation to provide clear and truthful information to customers. 3. Prioritizing customer education by offering official SIP resources. 4. Avoiding any statements that could be construed as guarantees of coverage beyond SIP statutory limits. When in doubt, consulting with compliance or legal departments is crucial to ensure accurate communication. Question 8. The assessment process reveals that a registered representative in California has recommended a municipal fund security to a client. The representative asserts that the investment aligns with the client's stated goal of capital preservation and income generation. However, the principal reviewing the recommendation is concerned about the potential for undisclosed conflicts of interest and the clarity of the risk disclosures provided to the client. Which of the following actions by the principal best ensures compliance with California regulations and FINRA rules regarding municipal fund securities? Option A. Requesting written confirmation from the representative detailing all disclosures made to the client regarding the municipal fund securities risks, fees, and any potential conflicts of interest, and comparing this to the client's documented profile and investment objectives. Option B. Proving the recommendation based on the representative's experience and the client's expressed desire for a specific type of investment, assuming the client understands the general risks of investing. Option C. Accepting the representative's verbal assurance that the investment is suitable and that all necessary information was conveyed to the client, given the client's stated objective of capital preservation. Option D. Focusing solely on whether the municipal fund security's historical performance meets the client's income generation goal, without further investigation into specific risk disclosures or potential conflicts. The correct answer is A. Requesting written confirmation from the representative detailing all disclosures made to the client regarding the municipal fund securities risks, fees, and any potential conflicts of interest, and comparing this to the client's documented profile and investment objectives. Explanation. The assessment process reveals a common challenge for principals overseeing registered representatives, ensuring that investment recommendations for municipal fund securities in California are not only suitable, but also fully compliant with the specific disclosure requirements mandated by California law and FINRA rules. This scenario is professionally challenging because it requires a principal to balance the representative's duty to the client with the firm's obligation to adhere to regulatory frameworks, particularly concerning the unique nature of municipal securities and the potential for conflicts of interest. Careful judgment is required to distinguish between a recommendation that is merely unsuitable and one that violates specific disclosure or suitability rules, which can have significant legal and reputational consequences. The best professional approach involves a thorough review of the representative's recommendation, focusing on whether all required disclosures regarding the investment's risks, fees, and any potential conflicts of interest were made to the client in writing, and whether these disclosures align with the client's financial situation and investment objectives as documented in the client's profile. This approach is correct because it directly addresses the core regulatory requirements for municipal fund securities, which emphasize transparency and client understanding. Specifically, FINRA Rule 2111, Suitability, and NAST Rule 2310, Recommendations, require that firms have a reasonable basis to believe a recommended security is suitable for a customer. For municipal securities, this includes understanding the specific risks associated with the issuer, the security itself, and any associated fees or expenses. California regulations, while not directly dictating specific disclosure content for all municipal securities, operate within this federal framework and emphasize investor protection. A principal must ensure the representative has not only identified suitable investments, but also provided the client with all necessary information to make an informed decision, including any potential conflicts of interest that might influence the recommendation. An incorrect approach involves accepting the representative's assurance that the investment is suitable without independently verifying that all required disclosures, particularly those related to the specific risks of municipal fund securities and any potential conflicts of interest, were provided to the client in writing and understood. This fails to meet the principal's supervisory responsibility to ensure compliance with both federal and state investor protection laws. Another incorrect approach is to focus solely on the client's stated investment objective, without adequately scrutinizing the specific risks inherent in the recommended municipal fund security, and whether these risks were clearly communicated. This overlooks the critical requirement to understand the product itself and its potential downsides. Finally, an approach that prioritizes closing the sale over ensuring comprehensive disclosure and suitability, even if the investment might eventually perform well, is ethically and regulatorily unsound. It demonstrates a disregard for the client's right to informed consent and exposes the firm to significant compliance violations. Professionals should employ a decision-making framework that begins with understanding the client's profile and objectives, then rigorously assessing the recommended investment's characteristics and risks, and finally confirming that all regulatory disclosure requirements have been met and documented. This involves a proactive review process, questioning assumptions, and seeking clarification when necessary, rather than passively accepting a representative's conclusion. Question 9. Investigation of a potential conflict of interest by a municipal advisor in California advising a city on a new bond issuance reveals that the advisor's firm has a pre-existing business relationship with a potential underwriter for the issuance. What is the most appropriate course of action for the municipal advisor to take to comply with MSRB rulemaking under the Securities Exchange Act of 1934, Section 15B? B. Option A. Attempt to resolve the conflict internally by having a different team within the firm handle the advisory services for the bond issuance, and only inform the city of the conflict if the internal resolution is unsuccessful. Option B. Disclose the relationship to the city, but minimize its potential impact, assuring the city that the advice will be objective and unaffected by the firm's business dealings. Option C. Immediately disclose the pre-existing business relationship with the potential underwriter to the city, detailing the nature of the relationship and any potential implications for the advice provided, and seek the city's informed consent to proceed. Option D. Proceed with providing advice on the bond issuance, assuming the relationship with the underwriter is not significant enough to influence the recommendation, and address any concerns only if they arise later. The correct answer is C. Immediately disclose the pre-existing business relationship with the potential underwriter to the city, detailing the nature of the relationship and any potential implications for the advice provided, and seek the city's informed consent to proceed. Explanation. This scenario is professionally challenging because it requires a municipal advisor to balance the interests of a municipality with the need to comply with MSRB rulemaking under the Securities Exchange Act of 1934, Section 15B. The advisor must ensure that their recommendations are not only financially sound for the municipality, but also adhere to the strict ethical and regulatory standards governing municipal advisory activities, particularly concerning conflicts of interest and fair dealing. Careful judgment is required to navigate potential conflicts and ensure transparency. The best approach involves proactively identifying and disclosing any potential conflicts of interest to the municipality before providing advice. This includes clearly outlining the nature of the conflict, how it might affect the advice given, and the steps the advisor will take to mitigate its impact. This approach is correct because it directly aligns with the MSRB emphasis on fair dealing and the avoidance of fraud and manipulation, as mandated by Section 15B of the 34 Act. Transparency and informed consent from the client are paramount in maintaining an ethical advisory relationship and fulfilling the advisor's fiduciary duty. An approach that involves providing advice without disclosing a potential conflict of interest is professionally unacceptable. This failure constitutes a breach of ethical conduct and violates the spirit and letter of MSRB rules designed to protect municipal entities from undue influence and ensure fair advice. Such an omission can lead to decisions that are not in the best interest of the municipality, potentially resulting in financial detriment and regulatory sanctions. Another unacceptable approach is to downplay the significance of a known conflict to the municipality. While disclosure is made, minimizing the potential impact misleads the municipality into believing the conflict is inconsequential. This undermines the principle of informed consent and can still lead to decisions influenced by the advisor's self-interest, thereby violating the duty of fair dealing. Finally, an approach that involves seeking to resolve the conflict internally without informing the municipality until after the advice has been given is also professionally deficient. While internal resolution might seem efficient, it bypasses the crucial step of client consent and transparency. The municipality has the right to know about potential conflicts upfront and to decide if they are comfortable proceeding with the advice, even after internal mitigation efforts. Professionals should employ a decision-making framework that prioritizes transparency, thorough conflict identification, and clear communication with the client. This involves a systematic process of assessing potential conflicts, evaluating their impact, disclosing them fully and promptly to the client, and obtaining informed consent before proceeding with any advisory services. Adherence to MSRB rules and ethical principles should guide every step of the advisory process. Question 10. Comparative studies suggest that principals of broker-dealers must possess a thorough understanding of investor protection mechanisms. If a customer of a now insolvent broker-dealer in California has two separate accounts, a joint account with a net equity of $400,000 consisting of $350,000 in securities and $50,000 in cash, and an individual retirement account IRA with a net equity of $170,000 consisting of $150,000 in securities and $20,000 in cash. What is the maximum amount the customer can expect to recover from the Securities Investor Protection Corporation (SIPC)? Option A, $400,000. Option B, $420,000. Option C, $500,000. Option D, $570,000. The correct answer is C, $500,000. Explanation: scenario analysis. This scenario presents a professional challenge because it requires a principal to accurately calculate potential SIP coverage for a customer facing a brokerage firm insolvency. Miscalculating coverage can lead to significant financial harm for the customer and potential regulatory sanctions for the principal and the firm. The principal must understand the nuances of SIP coverage limits and how they apply to different types of securities and account structures. Correct approach analysis. The best approach involves meticulously calculating the net equity for each separate account held by the customer at the insolvent firm. This means valuing all securities and cash at their market value as of the date of the SIP filing. For each separate account, the calculation would be \text net equity equals \text market value of securities plus \text cash balance \text customer liabilities \. SIP coverage is then applied to the total net equity across all separate accounts, up to the maximum limit of $500,000 per customer, with a sublimit of $250,000 for cash. In this case, the customer has two separate accounts, a joint account and an individual retirement account (IRA). The joint account's net equity is calculated as $350,000 securities plus $50,000 cash $0 liabilities equals $400,000. The IRA's net equity is calculated as $150,000 securities plus $20,000 cash $0 liabilities equals $170,000. The total net equity is $400,000 plus $170,000 equals $570,000. SIP coverage applies up to $500,000 per customer. Therefore, the customer is covered for $500,000 with $70,000 remaining uninsured. This approach is correct because it adheres to the Securities Investor Protection Act of 1970 (SIPA) and SIP guidelines, which mandate the calculation of net equity on a per customer, per brokerage firm basis, and differentiate coverage for cash and securities within the overall limits. Incorrect approach is analysis, an approach that simply sums all assets without considering separate account treatment, and the cash sublimit is incorrect. This would fail to recognize that SIP coverage is applied to each separate account's net equity and then aggregated for the customer, up to the overall limit. It also ignores the specific sublimit for cash. An approach that only considers the total market value of securities and ignores the cash balance and customer liabilities is incorrect. SIP coverage applies to both cash and securities, and liabilities owed by the customer to the firm reduce the net equity. An approach that applies the $500,000 limit to each account individually, rather than to the customer's total net equity across all accounts at the firm, is incorrect. SIP coverage is per customer, not per account. Professional reasoning. Professionals should adopt a systematic decision-making framework when dealing with customer claims against an insolvent firm. This framework should include 1. Identifying the customer and all accounts held at the firm. 2. Determining the date of the SIP filing, which establishes the valuation date for assets. 3. Calculating the net equity for each separate account by valuing securities and cash and subtracting any customer liabilities. 4. Aggregating the net equity across all separate accounts for the customer. 5. Applying SIP coverage limits, $500,000 per customer, $250,000 for cash, to the total net equity. 6. Clearly communicating the covered amount and any uninsured portion to the customer. This structured approach ensures compliance with regulations and ethical obligations to protect customer assets to the fullest extent possible under the law. Question 11. The investigation demonstrates that a principal of a California municipal issuer, in the lead-up to a significant bond offering, made statements to potential investors that emphasized the project's potential for future growth while downplaying current financial challenges and potential delays. The principal stated, "We're painting a picture of success, and that's what investors want to see." Which of the following represents the most appropriate response to this situation? Option A. Conduct a thorough review of all offering documents, marketing materials, and communications to ascertain if any material misstatements or omissions of fact occurred, comparing them against the issuer's actual financial condition and project risks. Option B. Accept the principal's explanation that the statements were made to create a positive marketing impression and were standard practice for promoting municipal securities. Option C. Conclude that no anti-fraud provisions were violated because the bond offering was ultimately successful in raising the necessary funds. Option D. Focus the investigation solely on whether the principal received any personal financial gain as a result of these statements. The correct answer is A. Conduct a thorough review of all offering documents, marketing materials, and communications to ascertain if any material misstatements or omissions of fact occurred, comparing them against the issuer's actual financial condition and project risks. Explanation. The investigation demonstrates a scenario where a municipal issuer's principal may have engaged in misleading practices, concerning the disclosure of material information related to a new bond offering in California. This situation is professionally challenging because it requires distinguishing between legitimate marketing efforts and fraudulent misrepresentations, particularly when dealing with complex financial instruments and the public trust inherent in municipal finance. The principal's actions could have significant legal and reputational consequences for the issuer and the individuals involved. The best professional approach involves a thorough and objective review of all communications and disclosures made by the issuer and its representatives. This includes scrutinizing the accuracy and completeness of information provided to potential investors, ensuring that no material facts were omitted or misrepresented. Specifically, this approach would involve gathering all relevant documents, interviewing key personnel, and comparing the disclosed information against the actual financial condition and risks associated with the bond offering. This aligns with the anti-fraud provisions applicable to all persons involved in municipal securities, including issuers and their principals, as outlined in federal securities laws and enforced by the Securities and Exchange Commission, SEC, and the Municipal Securities Rulemaking Board, MSRB. The MSRB Rule G17 on fair dealing and Rule G8 on record-keeping are particularly relevant, as are the general anti-fraud provisions of the Securities Act of 1933 and the Securities Exchange Act of 1934, which prohibit deceptive, manipulative, or fraudulent practices in the offer or sale of securities. An incorrect approach would be to dismiss concerns based on the principal's assertion that the information was presented in a positive light for marketing purposes. This fails to recognize that even marketing materials are subject to anti-fraud provisions and must not contain material misstatements or omissions. The intent to promote the offering does not excuse fraudulent conduct. Another incorrect approach would be to focus solely on whether the principal personally benefited financially from the alleged misrepresentations. Anti-fraud provisions are concerned with the act of deception and its impact on investors, regardless of whether the perpetrator directly profited. The harm to investors and the integrity of the market are the primary considerations. Finally, an incorrect approach would be to rely on the fact that the bond offering was ultimately successful in raising the intended capital. The success of an offering does not validate or excuse prior fraudulent conduct. Investors may have purchased bonds based on incomplete or misleading information, and their potential losses or the inherent risk they undertook due to such misrepresentations remain a violation of anti-fraud provisions. The professional decision-making process in such situations should involve a commitment to transparency, accuracy, and adherence to all applicable securities laws and regulations. Professionals must proactively identify and address potential disclosure issues, seek legal counsel when necessary, and prioritize investor protection above all else. This includes maintaining robust internal controls and compliance programs to prevent and detect fraudulent activities. Question 12. Assessment of a municipal securities dealer in New York's responsibility when reviewing an offering document for a new municipal bond issuance, where the issuer projects substantial revenue growth based on a novel, unproven technology, and the offering document contains optimistic financial forecasts. What is the most prudent course of action to ensure compliance with Section 10B and Section 15C of the Securities Exchange Act of 1934? Option A. Rely solely on the legal opinion provided by the issuer's counsel regarding the legality of the securities, without independently verifying the business and financial disclosures. Option B. Proceed with the offering, assuming the issuer's representations and optimistic projections are accurate, as the offering document has been prepared by the issuer's management. Option C. Disclose the existence of the unproven technology and optimistic projections to potential investors, but proceed with the offering without further investigation, as disclosure itself fulfills the dealer's obligation. Option D. Conduct independent due diligence to verify the feasibility of the technology and the reasonableness of the financial projections, ensuring the offering document is free from material misstatements or omissions. The correct answer is D. Conduct independent due diligence to verify the feasibility of the technology and the reasonableness of the financial projections, ensuring the offering document is free from material misstatements or omissions. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities dealer to navigate the complex interplay between Section 10(b) and Section 15(c) of the Securities Exchange Act of 1934, as interpreted by FINRA rules and SEC guidance, in the context of a potentially misleading offering document. The dealer must assess the adequacy of disclosure and their own due diligence obligations to prevent fraud and manipulation, ensuring compliance with federal securities laws and industry standards in New York. Failure to do so can result in severe regulatory sanctions, reputational damage, and civil liability. Correct approach analysis. The best professional practice involves a thorough review of the offering document for any omissions or misrepresentations that could mislead investors. This includes scrutinizing the financial projections and the disclosure of associated risks, particularly those related to the issuer's reliance on a single, unproven technology. The dealer must then exercise reasonable diligence to verify the accuracy and completeness of the information presented, especially concerning the viability of the technology and the market demand. If material deficiencies are identified, the dealer has a duty to ensure these are corrected or to refrain from participating in the offering. This approach directly aligns with the anti-fraud provisions of Section 10(b) and the dealer's obligation under Section 15(c) to conduct business in a manner that is fair and avoids fraudulent, manipulative, or deceptive practices. FINRA Rule 2110, which requires adherence to high standards of commercial honor and just and equitable principles of trade, further mandates this level of diligence. Incorrect approaches analysis. Proceeding with the offering without independently verifying the optimistic financial projections and the issuer's claims about the technology's readiness for commercialization is a significant regulatory failure. This approach neglects the dealer's affirmative duty to conduct due diligence and could lead to a violation of Section 10(b) by facilitating the distribution of materially misleading information. It also fails to meet the standards of fair dealing required by Section 15(c) and FINRA Rule 2110. Relying solely on the issuer's assurances, even if presented in a formal offering document, is insufficient when red flags, such as reliance on unproven technology and aggressive projections, are present. Furthermore, assuming that the presence of a legal opinion from the issuer's counsel negates the dealer's responsibility for the accuracy of the offering's substance is a misinterpretation of legal review versus substantive due diligence. A legal opinion typically addresses the legality of the securities and the offering structure, not the factual accuracy of the business and financial disclosures. Professional reasoning. Professionals should adopt a risk-based approach to due diligence, and faced with an offering that includes aggressive financial projections and relies on novel or unproven technology, heightened scrutiny is warranted. The decision-making process should involve 1. Identifying potential risks and red flags in the offering materials. 2. Assessing the issuer's capacity to deliver on its promises, including the technological feasibility and market acceptance. 3. Conducting independent verification of key assumptions and representation, especially those underpinning financial forecasts. 4. Consulting with internal compliance and legal departments when significant uncertainties or potential misrepresentations are discovered. 5. Determining whether to proceed with the offering, request amendments to the offering document, or withdraw from participation based on the findings of the due diligence process. Question 13. The monitoring system demonstrates that a client in California has requested an immediate redemption of their municipal fund securities. The client has not specified a reason for the redemption, but the principal recognizes that the timing of this redemption could have significant tax implications for the client due to their overall tax bracket and the current market performance of the fund. What is the most appropriate course of action for the principal? Option A. Advise the client to consult with a tax advisor to understand the implications of the redemption before any action is taken. Option B. Proactively discuss the potential tax consequences of the redemption with the client, explain how it might affect their tax liability, and explore alternative strategies if appropriate before processing the request. Option C. Immediately process the redemption request to meet the client's stated need for funds, assuming the client is aware of any potential tax implications. Option D. Recommend that the client delay the redemption until the end of the tax year to potentially minimize any immediate tax impact, without further discussion of the specifics. The correct answer is B. Proactively discuss the potential tax consequences of the redemption with the client explain how it might affect their tax liability, and explore alternative strategies if appropriate before processing the request. Explanation. This scenario presents a professional challenge because it requires a principal to balance the investor's immediate need for funds with the potential for adverse tax consequences arising from the timing of a municipal fund security redemption. The principal must ensure that advice provided is not only compliant with regulatory requirements, but also in the investor's best interest, considering their overall financial situation and tax liabilities. The correct approach involves proactively identifying the potential tax implications of the redemption and engaging in a detailed discussion with the investor about these consequences. This includes explaining how the redemption might trigger capital gains or losses, the applicable tax rates, and the potential impact on their overall tax liability for the year. The principal should then work with the investor to explore alternative strategies, such as delaying the redemption if feasible, or considering other investment options that might mitigate tax burdens, all while adhering to the Series 51 regulations and FINRA rules regarding suitability and best interest. This approach prioritizes investor education and informed decision-making, aligning with the ethical obligation to act in the client's best interest and the regulatory requirement to provide suitable recommendations. An incorrect approach would be to simply process the redemption request without any discussion of tax consequences. This fails to meet the duty of care owed to the investor and could lead to unexpected tax liabilities, potentially causing financial harm. It also neglects the principal's responsibility to ensure the investor understands the full implications of their investment decisions. Another incorrect approach would be to advise the investor to redeem immediately solely based on their stated need for funds, without considering the tax implications. This prioritizes the transaction over the investor's broader financial well-being and could be seen as a failure to provide suitable advice, especially if alternative, tax-efficient options were available. Finally, an incorrect approach would be to suggest the investor consult a tax advisor without first providing a clear explanation of the potential tax issues themselves. While referring to specialists is often appropriate, the principal has a direct responsibility to identify and explain the foreseeable tax consequences of a redemption from a municipal fund security under their purview. Professionals should approach such situations by first understanding the investor's stated objective. Then, they must assess the potential implications of fulfilling that objective, including regulatory compliance, suitability, and any foreseeable financial consequences like taxes. The next step is to clearly communicate these implications to the investor, offering a range of options and facilitating an informed decision that best serves the investor's overall interests. Question 14. Regulatory review indicates that a municipality in California has issued bonds to finance a new public infrastructure project. The principal amount of the bonds is substantial, and the municipality seeks to invest the bond proceeds prudently while awaiting disbursement for project construction. Given the absence of any state guarantees on these bond proceeds, what is the most appropriate strategy for investing these funds? Option A. Place the bond proceeds in a certificate of deposit CD with a highly rated commercial bank, without independently verifying specific California regulations for bond proceeds. Option B. Invest the bond proceeds in a broad portfolio of investment-grade corporate bonds and a selection of blue-chip equities to maximize potential returns. Option C. Utilize complex structured financial products recommended by an underwriter to achieve aggressive yield enhancement, assuming the underwriter's expertise. Option D. Invest the bond proceeds in U.S. Treasury bills and notes, and in a money market fund that invests solely in U.S. government securities, after confirming these are permitted by the bond indenture and California law. The correct answer is D. Invest the bond proceeds in U.S. Treasury bills and notes, and in a money market fund that invests solely in U.S. government securities, after confirming these are permitted by the bond indenture and California law. Explanation. Scenario analysis. This scenario presents a professional challenge for a municipal finance professional in California because it requires navigating the complexities of investing bond proceeds while adhering to strict regulatory limitations. The core challenge lies in balancing the need to generate returns on invested funds with the prohibition against state guarantees and the specific authorized uses of bond proceeds. Misinterpreting these regulations can lead to significant legal and financial repercussions for the issuer and the underwriter. Correct approach analysis. The best professional approach involves diligently researching and adhering to the specific investment guidelines outlined in the bond indenture and California state law governing municipal bond proceeds. This includes identifying investment vehicles that are explicitly permitted for such funds, such as U.S. Treasury obligations, certain government agency securities, or money market funds that meet specific criteria. The justification for this approach is rooted in the principle of fiduciary duty and strict compliance with the terms of the bond issuance and applicable state regulations. California law, like that in many jurisdictions, places stringent controls on how bond proceeds can be invested to ensure they are used for their intended public purpose, and to prevent speculative investments that could jeopardize the repayment of the bonds. Absence of state guarantees means that the investment strategy must be inherently conservative and aligned with the security of the principal. Incorrect approach is analysis. One incorrect approach involves investing bond proceeds in a diversified portfolio of corporate bonds and equities, even if managed by a reputable firm. This is problematic because it deviates from the conservative investment mandate typically associated with municipal bond proceeds. Such investments carry higher risk than permitted vehicles and may not align with the specific covenants of the bond indenture or California's regulations, which prioritize capital preservation and liquidity for the public purpose. Another incorrect approach is to rely on the advice of an underwriter who suggests investing in complex derivative products to maximize returns, without first verifying their legality and appropriateness under California law and the bond indenture. This fails to uphold the professional's responsibility to independently ensure compliance and manage risk appropriately, as derivative products often carry significant risks and may not be authorized for municipal bond proceeds. A third incorrect approach is to assume that any investment vehicle deemed safe by a financial institution is automatically permissible for bond proceeds. This overlooks the critical step of cross-referencing with the specific legal and contractual restrictions governing the bond issuance in California, which may impose limitations beyond general notions of safety. Professional reasoning. Professionals in this situation should adopt a systematic approach. First, thoroughly review the bond indenture and all relevant California statutes and regulations pertaining to municipal bond proceeds. Second, consult with legal counsel specializing in municipal finance to confirm the permissibility of any proposed investment. Third, prioritize investments that offer capital preservation and liquidity, aligning with the intended public purpose of the bond proceeds. Fourth, document all investment decisions and the rationale behind them, ensuring transparency and accountability. This structured process mitigates risk and ensures compliance with the stringent requirements governing municipal finance in California. Question 15. Consider a scenario in California where a client expresses a strong desire to reduce their federal tax liability and mentions that they are interested in investments that can provide tax-exempt income. As a registered principal, you are aware that municipal fund securities can offer federal tax exemption on their income. What is the most appropriate course of action to ensure compliance with suitability rules and ethical obligations? Option A. Engage in a detailed discussion with the client to understand their overall financial situation, investment objectives, and risk tolerance, and then explain the specific characteristics of municipal fund securities, including their potential for principal fluctuation, tax advantages, and associated risks, before making any recommendation. Option B. Immediately recommend municipal fund securities, highlighting their tax-exempt income feature as the primary benefit to help the client reduce their federal tax liability. Option C. Advise the client that municipal fund securities are a guaranteed method to achieve tax-exempt income and will protect their principal while offering tax benefits. Option D. Focus exclusively on the tax benefits of municipal fund securities, emphasizing how they can shelter income from federal taxes, without discussing any potential risks or the possibility of principal loss. The correct answer is A. Engage in a detailed discussion with the client to understand their overall financial situation, investment objectives, and risk tolerance, and then explain the specific characteristics of municipal fund securities, including their potential for principal fluctuation, tax advantages, and associated risks, before making any recommendation. Explanation. Scenario analysis. This scenario presents a professional challenge because a registered principal must balance the client's stated investment objective with the inherent risks and complexities of municipal fund securities. The principal's duty is to ensure that any recommendation is suitable for the client, considering their financial situation, investment objectives, and risk tolerance. Misunderstanding or misrepresenting the nature of municipal fund securities, particularly their potential for principal loss and their tax implications, can lead to significant client harm and regulatory violations. Careful judgment is required to navigate the nuances of these products and ensure compliance with FINRA rules and state-specific regulations governing municipal securities. Correct approach analysis. The best approach involves a thorough understanding of the client's financial profile and investment objectives, followed by a detailed explanation of municipal fund securities, including their specific risks, tax advantages, and potential for principal fluctuation. This approach prioritizes client suitability and transparency. It requires the principal to confirm that the client understands that municipal fund securities, while offering tax benefits, are not risk-free and can experience losses in principal value. This aligns with FINRA Rule 2111, suitability, and the general ethical obligation to act in the client's best interest, ensuring the client is fully informed before making an investment decision. Incorrect approach is analysis. Recommending municipal fund securities solely based on the client's desire for tax-exempt income without a comprehensive discussion of principal risk and potential for loss is a failure to meet suitability requirements. This approach overlooks the critical aspect that municipal fund securities are subject to market fluctuations and can lose value, which may contradict a client's implicit or explicit need to preserve capital. Suggesting that municipal fund securities are a guaranteed way to achieve tax-exempt income without disclosing the possibility of principal loss is misleading and violates the principle of fair dealing. This misrepresentation can lead a client to believe they are making a risk-free investment, which is factually incorrect for any fund security. Focusing only on the tax benefits and downplaying or omitting any discussion of the underlying risks, such as interest rate risk, credit risk, or market risk, constitutes a failure to provide a balanced and complete picture. This selective disclosure prevents the client from making an informed decision and breaches the principal's duty of care. Professional reasoning. Professionals should employ a decision-making framework that begins with a deep dive into client discovery. This involves actively listening to and documenting the client's financial situation, investment objectives, time horizon, and risk tolerance. Following discovery, the professional must possess robust product knowledge, understanding the features, benefits, risks, and tax implications of any security being considered. Recommendations should then be directly linked to the client's profile, with a clear articulation of how the product meets their specific needs and objectives, while also fully disclosing any associated risks. Transparency and a commitment to the client's best interest should guide every step. Question 16. Upon reviewing new marketing materials for a municipal fund security intended for distribution to clients in California, what is the most prudent course of action for a principal to ensure compliance with both state and federal regulations? Option A. Focus on the general characteristics of municipal securities and approve the materials if they appear to align with typical industry practices, without a detailed review of the specific offering documents. Option B. Approve the marketing materials based on the anticipated profitability of the new municipal fund security, assuming the product sponsor has already ensured regulatory compliance. Option C. Expedite the approval process by relying on the sales team's assurance that the materials are suitable for clients, given the urgency to introduce the new product to the market. Option D. Conduct a thorough review of the municipal fund securities offering documents and associated marketing materials to ensure they accurately reflect the product's features, risks, and fees, and that these materials comply with all applicable California state regulations and FINRA rules for municipal fund securities. The correct answer is D. Conduct a thorough review of the municipal fund securities offering documents and associated marketing materials to ensure they accurately reflect the product's features, risks, and fees, and that these materials comply with all applicable California state regulations and FINRA rules for municipal fund securities. Explanation. This scenario is professionally challenging because it requires a principal to balance the need to understand a new product with the regulatory obligation to ensure that recommendations made to clients are suitable. The principal must not only grasp the intricacies of municipal fund securities, but also apply this knowledge within the specific regulatory framework governing their sale in California. The pressure to quickly approve marketing materials for a new product can lead to overlooking critical compliance steps. The best approach involves a thorough review of the municipal fund securities, offering documents and associated marketing materials to ensure they accurately reflect the product's features, risks, and fees, and that these materials comply with all applicable California state regulations and FINRA rules for municipal fund securities. This includes verifying that the materials do not contain misleading statements or omissions, and that they adequately disclose potential risks to investors. This aligns with the principal's supervisory responsibility under FINRA Rule 3110 and the duty to ensure compliance with state securities laws, such as the California Corporate Securities Law of 1968, which requires that offerings be registered or exempt, and that sales practices are not fraudulent or deceptive. An approach that focuses solely on the potential profitability of the new product, without a deep dive into its risk profile and regulatory compliance, is professionally unacceptable. This would violate the principal's duty of supervision and could lead to the dissemination of misleading information, exposing both the firm and its clients to significant risk. It also fails to uphold the ethical obligation to prioritize client interests. Another unacceptable approach is to approve the marketing materials based on a general understanding of municipal securities without specifically reviewing the offering documents for this particular fund. This overlooks the unique characteristics and risks associated with different municipal fund securities and the specific disclosures required by California regulations. It represents a failure in due diligence and supervisory oversight. Finally, approving the materials solely because they were prepared by the product sponsor, assuming they are inherently compliant, is a dereliction of duty. While sponsors have responsibilities, the principal's ultimate responsibility is to ensure that all materials used by their firm are accurate, not misleading, and compliant with all relevant laws and regulations before they are distributed to the public in California. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the product, a meticulous review of all associated documentation for accuracy and compliance, and a clear assessment of potential risks and suitability for clients, all within the specific jurisdictional requirements of California and applicable federal regulations. Question 17. When evaluating a municipal fund security account established under the Uniform Transfers to Minors Act (UTMA) in California, and the custodian inquires about withdrawing funds for a purpose not directly related to the minor's immediate needs and also wishes to change the named beneficiary, what is the most appropriate course of action for the financial professional? Option A. Inform the custodian that they can use the funds for their own needs as long as they intend to replenish the account later and can simply fill out a form to change the beneficiary. Option B. Recommend that the custodian proceed with the withdrawal for their personal use and change the beneficiary to whomever they choose, as they are the custodian. Option C. Advise the custodian to meticulously document the proposed withdrawal's benefit to the minor and to consult legal counsel regarding the formal process for any potential beneficiary change under the California UTMA. Option D. Suggest that the custodian can make informal decisions about fund usage and beneficiary changes as long as they believe it is in the minor's best interest, without needing to follow specific legal procedures. The correct answer is C. Advise the custodian to meticulously document the proposed withdrawal's benefit to the minor and to consult legal counsel regarding the formal process for any potential beneficiary change under the California UTMA. Explanation. When evaluating a situation involving a municipal fund security account for a minor, the primary professional challenge lies in balancing the beneficiary's best interests with the need to adhere strictly to the Uniform Transfers to Minors Act (UTMA) regulations in California. The UTMA imposes specific rules regarding the use of funds and the process for changing beneficiaries, requiring careful judgment to avoid violations. The best professional approach involves meticulously reviewing the California UTMA provisions concerning withdrawals for non-qualified uses and beneficiary changes. This includes understanding that withdrawals must be for the benefit of the minor, and any proposed non-qualified use requires thorough documentation and justification demonstrating this benefit. Furthermore, changing a beneficiary under the California UTMA is a formal process that typically requires the custodian to petition the court or follow specific statutory procedures, rather than simply making an informal request. Therefore, advising the custodian to gather all documentation for the proposed withdrawal and to initiate the formal legal process for any beneficiary change, if permissible under the UTMA, is the correct course of action. This aligns with the regulatory framework's emphasis on protecting the minor's assets and ensuring proper administration. An incorrect approach would be to advise the custodian that they can unilaterally decide to use the funds for a purpose not directly benefiting the minor, such as for the custodian's personal expenses, even if they intend to repay it later. This directly violates the UTMA requirement that funds be used for the minor's benefit. Another incorrect approach is to suggest that the custodian can simply name a new beneficiary by filling out a form provided by the financial institution without adhering to the formal legal procedures mandated by the California UTMA for such changes. This bypasses critical legal safeguards designed to protect the minor's inheritance. Finally, advising the custodian to ignore the UTMA rules and proceed with the withdrawal or beneficiary change based on their personal judgment, without consulting legal counsel or understanding the specific statutory requirements, is professionally negligent and exposes both the custodian and the financial institution to significant legal and ethical risks. Professionals should employ a decision-making framework that prioritizes understanding and adhering to the specific state's UTMA regulations. This involves 1. Identifying the governing jurisdiction, California in this case. 2. Thoroughly researching the relevant sections of the California UTMA concerning withdrawals for non-qualified uses and beneficiary changes. 3. Consulting with legal counsel when complex or ambiguous situations arise, particularly regarding beneficiary changes. 4. Documenting all advice and actions taken. 5. Always acting in the best interest of the minor beneficiary, as mandated by the UTMA. Question 18. The analysis reveals that a principal at a registered broker-dealer in Ontario, Canada, is responsible for overseeing the marketing and sales practices related to the firm's proprietary municipal fund securities. Given the potential for conflicts of interest and the need to protect investors from misleading information, what is the most effective approach to mitigate the risk of anti-fraud violations in this context? Option A. Focus solely on ensuring that individual statements within marketing materials are factually correct, without considering the overall impression or context they create for potential investors. Option B. Implement a post-distribution review process for marketing materials, addressing any identified issues only after they have been disseminated to the public. Option C. Develop and implement comprehensive written policies and procedures that mandate a risk-based assessment of all marketing materials and sales practices for proprietary municipal fund securities, ensuring accuracy, completeness, and fair representation of risks and benefits. Option D. Rely on the experience and judgment of the sales team to ensure compliance with anti-fraud regulations, assuming they are aware of the general principles of fair dealing. The correct answer is C. Develop and implement comprehensive written policies and procedures that mandate a risk-based assessment of all marketing materials and sales practices for proprietary municipal fund securities, ensuring accuracy, completeness, and fair representation of risks and benefits. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent conflict between a firm's desire to promote its proprietary municipal fund securities and the paramount regulatory obligation to prevent fraud and ensure suitability for investors. The principal's role is to uphold these standards, requiring a keen understanding of anti-fraud provisions and the ability to assess risk in marketing practices. Careful judgment is required to distinguish between legitimate promotion and potentially misleading or fraudulent activities. The best approach involves proactively establishing and enforcing clear, written policies and procedures that specifically address the marketing and sale of proprietary municipal fund securities. This includes mandating thorough risk assessments for all marketing materials and sales practices, ensuring they accurately represent the security's risks and characteristics without omission or exaggeration. This approach is correct because it aligns directly with the principles of anti-fraud under securities regulations, which require firms to act with diligence and care to prevent deceptive practices. By having robust internal controls and a risk-based assessment framework, the firm demonstrates a commitment to compliance and investor protection, thereby mitigating the risk of fraudulent or misleading conduct. This proactive stance is essential for principals to fulfill their supervisory responsibilities. An incorrect approach would be to rely solely on the sales team's understanding of regulatory requirements and their past performance. This fails to provide a structured framework for risk assessment and leaves the firm vulnerable to individual lapses in judgment or knowledge. Neglects the principal's duty to implement and oversee compliance systems, potentially leading to violations of anti-fraud rules by allowing misleading statements or omissions to reach investors. Another incorrect approach is to assume that as long as the marketing materials are factually accurate in isolation, they are compliant. This overlooks the crucial element of context and the potential for misrepresentation through omission or the overall impression created. Anti-fraud provisions extend beyond mere factual accuracy to encompass the entire communication and its potential to deceive or mislead investors about the risks or benefits of the securities. Finally, an incorrect approach would be to only review marketing materials after they have been distributed to the public. This reactive stance is insufficient for preventing fraud. Regulatory expectations, particularly concerning anti-fraud, emphasize a proactive and preventative approach. Waiting for issues to arise after distribution means that potential harm to investors may have already occurred, and the firm's ability to demonstrate due diligence in preventing such harm is significantly weakened. Professionals should employ a decision-making framework that prioritizes a comprehensive understanding of anti-fraud regulations, the specific risks associated with the products being offered, and the implementation of robust internal controls. This involves establishing clear policies, conducting regular training, performing thorough risk assessments of all marketing and sales activities, and maintaining a culture of compliance where potential issues are identified and addressed proactively. Question 19. The evaluation methodology shows that a principal of a firm registered in California is reviewing an offering for a security issued by a public authority established by the state of California to finance infrastructure projects. The repayment of the security is derived from revenue generated by a private corporation that will lease the financed facility. To ensure compliance with the Securities Exchange Act of 1934, which of the following actions is most appropriate for the principal to take? Option A. Rely on the issuer's classification of the security as a municipal bond without conducting an independent review of its characteristics. Option B. Ascertain if the security meets the definition of a municipal security under Section 3(a)(29) of the Securities Exchange Act of 1934, paying close attention to the criteria for industrial development bonds and the source of repayment. Option C. Apply general exemptions for municipal securities without considering the specific details of Section 3(a)(29) regarding revenue sources. Option D. Assume the security is exempt from the registration and reporting requirements of the Securities Exchange Act of 1934 because it is issued by a California public authority. The correct answer is B. Ascertain if the security meets the definition of a municipal security under Section 3(a)(29) of the Securities Exchange Act of 1934, paying close attention to the criteria for industrial development bonds and the source of repayment. Explanation. The evaluation methodology shows that a principal of a firm registered in California overseeing the sale of municipal securities must understand the specific exemptions and definitions under the Securities Exchange Act of 1934, particularly Section 3(a)(29). This scenario is professionally challenging because the definition of a municipal security can be nuanced, and misinterpreting it can lead to non-compliance with federal securities laws, potentially exposing the firm and its principals to regulatory action and reputational damage. The principal's role requires a deep understanding of the regulatory landscape to ensure all offerings are properly classified and handled. The best approach involves a thorough review of the specific characteristics of the security in question against the definition provided in Section 3(a)(29) of the Securities Exchange Act of 1934. This includes verifying that the issuer is a state or political subdivision, or an agency or instrumentality thereof, and that the security is an industrial development bond, where the issuer is a state or political subdivision, or an agency or instrumentality thereof, and the repayment of the bond is derived from payments made by a private entity. This meticulous examination ensures accurate classification, which is fundamental to determining applicable registration, disclosure, and anti-fraud provisions. This aligns with the ethical obligation to conduct business with integrity and in accordance with all applicable laws and regulations. An incorrect approach would be to assume that any security issued by a government entity is automatically exempt from all provisions of the 34 Act without further scrutiny. This overlooks the specific carve-outs and definitions within Section 3A, 29, that may subject certain types of municipal securities, particularly industrial development bonds financed by private entities, to specific regulatory requirements. This failure to conduct due diligence can lead to violations of securities laws. Another incorrect approach is to rely solely on the issuer's representation that the security is a municipal bond, without independent verification of its characteristics against the statutory definition. While issuers are expected to provide accurate information, the ultimate responsibility for classification and compliance rests with the broker-dealer and its principals. This reliance without verification is a dereliction of professional duty. Finally, an incorrect approach is to apply general exemptions for municipal securities without considering the specific nuances of Section 3A, 29, concerning industrial development bonds. This demonstrates a superficial understanding of the law and a failure to appreciate that not all securities issued by governmental entities receive the same treatment under federal securities regulations. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the relevant statutes and regulations. This involves proactively researching and understanding definitions, exemptions, and disclosure requirements, and applying them diligently to each specific security. When in doubt, seeking guidance from legal counsel or compliance experts is a crucial step in ensuring adherence to regulatory standards and ethical conduct. Question 20. Implementation of a new compliance tracking system for registered representatives in New York is being considered by a municipal fund securities principal. The firm needs to ensure all registered representatives have completed their annual compliance examinations as mandated by FINRA rules and federal regulations. The principal is evaluating several options for tracking these completions. Given the requirements of Section 15B, C, 7A of the Securities Exchange Act of 1934, which mandates broker-dealers to establish and maintain procedures to supervise the activities of their associated persons, what is the most compliant and effective method for tracking these examinations? Option A. Maintain a shared spreadsheet that is manually updated by an administrative assistant based on verbal confirmations from registered representatives regarding their examination completion. Option B. Require registered representatives to submit scanned copies of their examination completion certificates via email to the principal for manual filing. Option C. Implement a system that automatically receives completion data directly from the approved compliance examination provider, logs the date of completion for each representative, and generates alerts for outstanding requirements. Option D. Conduct quarterly random spot checks of 10% of registered representatives' compliance examination records to verify completion. The correct answer is C. Implement a system that automatically receives completion data directly from the approved compliance examination provider, logs the date of completion for each representative, and generates alerts for outstanding requirements. Explanation. Scenario analysis. This scenario presents a common challenge for municipal fund securities principals, balancing the need for efficient compliance oversight with the regulatory imperative to ensure thorough and accurate record-keeping. The principal must determine the most effective and compliant method for tracking and verifying the completion of required compliance examinations for registered representatives. Failure to do so can lead to regulatory sanctions under Section 15B, C, 7A of the Securities Exchange Act of 1934, which mandates that broker-dealers establish and maintain procedures to supervise the activities of their associated persons. The challenge lies in selecting a system that is both practical for the firm and demonstrably meets regulatory expectations for diligence and accuracy. Correct approach analysis. The best approach involves establishing a centralized, automated system that directly interfaces with the compliance examination provider. This system should automatically record the completion date of each examination for every registered representative. Upon completion, the system should generate a notification to the principal and update the representative's compliance record. This method is correct because it minimizes manual data entry, thereby reducing the risk of human error and ensuring the accuracy and completeness of records. It provides an auditable trail of completion dates and allows for proactive monitoring of outstanding requirements. This aligns with the spirit and letter of 34 Act, Sec. 15B C. 7a by creating a robust supervisory framework that ensures all representatives are meeting their regulatory obligations in a timely and verifiable manner. Incorrect approaches analysis. One incorrect approach is to rely on registered representatives to self-report the completion of their compliance examinations by submitting scanned copies of certificates to the principal. This method is flawed because it introduces significant risk of delayed reporting, lost documents, or even falsified submissions. The principal cannot independently verify the authenticity or timely completion of these examinations, creating a gap in the firm's supervisory responsibility and potentially violating the record-keeping requirements under the 34 Act. Another incorrect approach is to maintain a spreadsheet manually updated by an administrative assistant based on periodic verbal confirmations from registered representatives. This method is problematic due to its reliance on manual data entry and indirect verification. Verbal confirmations are inherently less reliable than direct system integration, and manual spreadsheets are prone to errors, omissions, and outdated information. This lack of a direct, verifiable link to examination completion undermines the firm's ability to demonstrate effective supervision as required by Section 15B C. 7. A further incorrect approach is to conduct random spot checks of a small percentage of registered representatives' compliance examination records quarterly. While some level of checking is better than none, this method is insufficient to meet the regulatory standard. Section 15B C. 7a implies a need for comprehensive supervision, not just periodic sampling. A random spot check does not guarantee that all representatives are compliant and leaves the firm vulnerable to regulatory scrutiny if an unregistered or non-compliant representative is discovered through other means. It fails to establish a proactive and systematic process for ensuring universal compliance. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes automation, direct verification, and comprehensive record-keeping. When evaluating compliance processes, consider the following. 1. Regulatory mandate. What specific requirements does the relevant regulation, in this case 34 Act Sec. 15B C. 7a, impose regarding supervision and record-keeping? 2. Risk assessment. What are the potential risks associated with each proposed method, e.g., human error, data loss, lack of verification, delayed reporting? 3. Efficiency vs. compliance. While efficiency is important, it must not come at the expense of regulatory compliance and robust supervision. 4. Auditability. Can the chosen method provide a clear, auditable trail of compliance activities? 5. Proactive monitoring. Does the system allow for proactive identification of noncompliance rather than reactive discovery? By applying this framework, professionals can select and implement compliance procedures that are not only effective but also demonstrably meet regulatory expectations.